another confirmation that this was going to be a good trade. So here is a single session called the shooting star. Okay. Now I'm going to harp on something over the next 4 or 5 patterns. But notice, what did the shooting star do? The shooting star means it went up and it went all the way down, all in the same session. It opened up here, it went up, and it went back down. Okay, all in the same session to get this shape. Okay. Now, if we think about just for a second, okay, let's do that one with red. This one was red. Imagine a bar here. I'm sorry, my scribbles aren't too neat here. And imagine a bar here. So imagine that we opened up here and went up, and then in the next bar opened here and went all the way back down. My point is, if you take a look at that, that's an engulfing pattern, right? That would be a bearish engulfing pattern. And yet, if I combine those 2 candlesticks together, what I get is that shooting star pattern. In other words, the shooting star pattern is effectively an engulfing pattern on a different time scale. Okay? You can say the same thing the other way around. If you combine these two, you get a shooting star pattern. So you can say the shooting star is engulfing on a different time scale, or you can say the engulfing pattern is a shooting star on a different time scale. This is the point to understand, is because this is a shooting star is considered one of the strongest signals. The bullish and the bearish engulfing is considered a strong signal. Effectively, on different time scales, you can see that they're the same. Let's take a look at the shooting star. This is on a 5-minute time scale. So the shooting star happens here. Very often we're going to talk about confirmation. So let's wait till the next pattern. But basically, I want to talk about the idea of confirming your trade. So here was the pattern, and sure enough, we had a nice trend up, and then you have this single session bar, which is actually all the way up and all the way down during the same time frame, and we had a nice move down. Once again, it happened right at the end while the trend indicator was still indicating green. So again, on the front edge there, it's a nice leading indicator. Okay, so the hammer. The hammer is the same thing in reverse. We've got a downtrend. This opens here, moves all the way down, and comes all the way back up in the same session. Remember before we would have called that a bullish engulfing pattern, right? This would have been a bullish engulfing pattern, but on a different time frame. It sets it, and it looks like this. Okay, so let's move on to look at an example or two of this one. Here's in a 2-minute time frame, diamond offshore. Okay, so the signal comes here. You see it moves all the way down and all the way back up in the same session. This is it on a bigger scale. Okay, let's touch on the market profile concept just for a second. Okay, we use market profile to create support and resistance lines. We think that market profile is a very practical way to combine with Japanese candlesticks because you're getting important price points from the market. So basically, the blue line in our picture here is the volume-weighted average price, okay, which comes straight from the concept of market profile. This is literally just taking how many trades happened at each of these prices times the volume that happened at each of those prices. We compile that and we watch that for different time frames, but usually on when we're watching intraday stuff, we're watching them for the day. So basically, it's telling you that this is the place that most of the trading has happened, okay? So when you see something down here, this is sitting right on the second standard deviation line below. And as you guys know from standard deviation lines, that means that 97% of the trades have happened above this line, okay? So when I get a downtrend and I get a reversal signal here that's telling me that, that's a possibility of a reversal, and it's happening on the second standard deviation down, to me, that's an extra strong confirmation, okay? Because this is a line that all day things have been bouncing off that line. It hasn't been going below that line very much during the course of the trading day. So when I get a reversal pattern sitting right there, I have a lot more confidence. My target is normally back here to the VWAP. In this case, it went right through the VWAP line and moved on up here. So there's a lot more we can talk about market profile, but the general concept is we watch the data from the trades all day to create the VWAP line. For products without volume, by the way, we use the TWAP, right, the time-weighted average price rather than VWAP. We create the first and second standard deviation lines up and down, and we do use those as important points for getting in and getting out of the trade, and the target prices. We use the market profile. It helps us create, as I was saying earlier, a more complete full strategy as opposed to just a setup, okay? So if I'm adding market profile into Japanese candlesticks, I can say that I have a form of a strategy here, right? Because now I say, okay, yes, I have a reversal pattern. Yes, it's on the second standard deviation, so therefore I'd like to get in. And I even have a target. For me, the target would have been here. Would have been the volume-weighted average price. Of course, I'm not going to shut it down just because I hit it there. I'm going to wait for some type of reversal. Probably I would have closed it in here, okay? Because then I get a candlestick that looks like it's coming back down. Okay. Let's look at a couple more. The bullish harami. And now we're going to start getting into some of them that are a little weaker. Okay, these are not as strong of signals as the three we've looked at. Okay, the hammer, the shooting star, and the engulfing pattern. Okay, so what makes it weaker? And again, I'm going to say the same thing I said a moment ago. Let's take a look at something like this. A bullish harami. We've had a downtrend. Okay, we have a big bar down, or some sizable, doesn't have to be as big as I drew it here. And now we have a bar contained within the body of the previous bar. And as I mentioned earlier, you're going to see a very clean harami much more often when you're looking at daily bars than when you're watching intraday, because intraday, very often the close of one and the open of the other are synonymous. Okay, but this is the original concept of a bullish harami. Now, a bullish harami, like the doji, is something that you should pay attention to. It does not mean to trade it. It's not a strong enough signal to make a trade on its own. So what you want to have is, when you see the bullish harami, you would like to see that the next bar, or possibly the bar after, confirms that this is a move in that direction. Okay? So basically, it means put your eyeballs on it, but watch to see if you get confirmation. So in the picture we put here, there's a downtrend, okay? And we have the harami here. Then we get a confirmation, but guess what? Personally, I'm not going to trade it until I get another confirmation. This confirmation was there, but it's not as strong. I'm going to trade this one at the second one. Okay, so basically, if you look at these three here, imagine, once again, I'm going to make the analogy back to the engulfing pattern. Imagine this bar being down. Imagine all three of these bars being combined together. What do I get? I get something that looks like this, right? When I get this, effectively, I have my engulfing pattern now. It just happened to come in 3 sessions instead of 1 session. So, once again, the idea here, the bullish harami is not by itself a strong signal. You wait when you get something like a harami, and the next 2 signals we're going to look at are all fall in the same category. When you get this type of signal, you wait for confirmation. Okay? Like all candlestick patterns, you have to have a trend. When you have a trend, then you have the harami. Now, in this case, you wait for your confirmation before you make the trade. It's an important concept. Some patterns, the first 3 we looked at, can often be traded on their own. I do not suggest that with the harami or the next couple of patterns. So let's take a look at a harami pattern here. So it has a nice trend down, right? And you can see all the trend indicators saying red, red, red. You get the bullish harami. Notice it came in before the trend reversed on the trend indicator. So again, a leading indicator. Then we get a confirmation. So a nice look for that. And this happened. This is a daily bar. Now, you know, depending on your nature, Skip, you were asked about market profile. Here's another example. This came right down to the second standard deviation line. I got my reversal pattern. I'm looking for it to go back to here. Okay? This is my look. So even though it bounced off of this line, which is something to watch for as you're crossing the first standard deviation line. So remember that the volume weighted average price is used by a lot of people nowadays. And so these lines and the first standard deviations away from the volume weighted average price, they're used by a lot of institutions to measure their traders to see how well they did. So these are important lines. I do watch for them as they come across here. I don't think I would have gotten out of this trade at this point, but I might have said this is enough, and I might have gotten out right here. Okay, but if you survive that, it went right back to the volume weighted average price in this case. Let's look at a bearish harami. Same concept, but heading down. Nice trend up. We have our harami pattern. Now we're going to look to see if we get a confirmation. And sure enough, we got our confirmation and a nice trend down. Now this is one that was bouncing off the first standard deviation down below. So you have to decide if, generally I'll make these types of trades if, how do you say, the market conditions. In any types of trend trading and reversals of trends, you should keep an awareness of the overall market conditions. On a day when the overall trend of the market has been down, okay, and let's say we had a little pullback here, then I'm waiting for this reversal to join back in the trend of the marketplace, okay? I wouldn't fight this trend. If the general market was up or sideways, I probably would not put this trade on because it's, you know, the general tendency is to head back to the volume weighted average price line. So I would put this trade on only if the general trend in the market was down. Okay, another one, same kind of concept. Dark cloud. You've got a trend up. The difference between the dark cloud and the harami is that the dark cloud actually opens up higher and comes down into the body of the previous bar, as opposed to being totally, you know, inside the previous bar. Nevertheless, I won't trade the dark cloud until I see that the next bars come down here. So again, I'm gonna wait for a confirmation. When I get a dark cloud pattern, I'm gonna wait for a confirmation. So in the case that we're looking at here in this picture, okay, I might have traded it here because this is hitting the close. Certainly I would be trading it in here. Look at a couple of examples. So here's a beautiful trade up. You know, this is the kind of pattern, if you trade with Japanese candlesticks very much, when you see this, it's right on one of the standard deviation lines. It just had a reversal pattern and you get a confirmation. Don't even blink, just trade that one. That's a perfect picture. That's an ideal kind of picture for trading. Memorize that picture. Trade it every time. Notice, by the way, that the confirmation for the dark cloud cover didn't come in the first bar, it came in the second bar afterwards. Okay? That happens very often. So how do we do here? Yeah, it's a nice trade. Notice also here the stochastic indicator, was right in line with everything else. So everything together was clearly telling you to trade that one. A perfect pattern, the stochastics are there. Everything looked right for that type of trade. Piercing is the other way around, right? Piercing is exactly the same except coming from the bottom. So this is a bullish signal. Same concept as the previous. Coming this way, you get the pattern that opens up partway into the body. Once again, remember, we're waiting for the picture when all of these bars together equal our bullish engulfing. So once you get your confirmation that that occurs, and this picture here, it could have been here, probably should be here, then it's time to make that trade. We get our piercing pattern here. And again, it had a few bounces around before it made it back to here. I would be starting to watch it carefully as it crossed some of these lines. But that's a typical kind of thing for a piercing, that type of pattern.